From Wish TV and the All Indiana Podcast Network, this is the Business, Equity, and Opportunities Podcast with Scott Sander.
Welcome to the Business, Equity, and Opportunities Podcast. I'm Scott Sander. On this episode, an interview with economist Tom Jalics, who puts some perspective on the outlook for 2025.
Every business is unique and has a target audience. If you own or manage a business, Circulus Digital Media can help you connect and grow your customer base with turnkey digital solutions that are nimble, offering best-in-class results, service, and support to reach a bigger customer base, allowing you to pinpoint a specific audience down to the smallest details. Get outside the city, the state, span the globe. Put Circulus Digital Media to work for you. Get started now at circulusdigital.com. That's circulusdigital.com.
Welcome back to Business, Equity, and Opportunities. We're pleased this time to now be joined by a voice who, if he doesn't have a crystal ball or the actual tea leaves, has a pretty good idea of what we should be watching for as we launch into 2025. Tom Jalics is with Fifth Third Bank, a bunch of titles which indicates he knows money well. Senior Vice President, Managing Director, Chief Investment Strategist, and now friend of Business, Equity, and Opportunities. Tom, thanks for being with us today. Are you looking forward to the year ahead?
Absolutely. I'm delighted to be here. Thanks for the invite. Looking forward to our conversation. And we're pretty optimistic on 2025. Looking forward to getting it going.
One thing we have learned about dollars and cents over the years is it is impossible to know exactly what's going to happen with anything. But in general, what are the things people should be looking forward to in the year ahead? Some of the cautionary things they might want to mind as well.
No, I think that's right. It's we are optimistic on the prospects for economic growth domestically in 2025. What we see is a relatively strong jobs market, unemployment rates with a low 4 handle that is lower than 90% of the reading since World War II. People that want jobs have jobs. If you learn anything from this conversation, it's that 68% of the U.S. economy is driven by consumer spending. Consumer spending is driven by job. So as long as the job market kind of hangs in there, people are working, earning paychecks. They're typically spending those paychecks and moving the economy forward. I think one of the challenges that I think small businesses will have in 2025 is just finding workers. It's a very, very tight labor market. It's very difficult to find somebody to come work with you or for you. And that's a limiting factor for not only small businesses, for large businesses as well. And aside from that, we're optimistic. Again, we're seeing inflation that's been coming down pretty dramatically over the last 24 months. We have a Federal Reserve, which was raising short-term interest rates for the past 2.5 years. It's now lowering interest rates. When you lower interest rates, you have a lower cost of capital. It's more of an incentive for business owners to borrow and invest, so they typically do that. So now we have a tailwind of shorter-term interest rates.
I don't need to tell you that sometimes the headline grabs, but it doesn't tell the full tale. Let's go through a few of those things that you mentioned. So the headline may say a major company cuts so many jobs. The reality may be this economy still added a significant number over the month, but it didn't grab that headline. What do you watch when you look at the job numbers?
We look at non-farm payrolls, right? So the government has lots and lots of statistics that can really put you in a lot of different directions. But every single month, the thing we look at is non-farm payrolls. And we want to see job ads on a monthly basis. Every single month for the last 2.5 years, when we look at the Bureau of Labor Statistics non-farm payroll report, we are adding to payroll, not without fail. We have a chart in one of our slide decks that we've added just about 9 million non-farm jobs over the last 2.5 years. That doesn't happen when you've got an economy that's wobbling, slowing down, or near a recession. Every time that you have economic troubles in our country, you find the jobs picture degrades, the job ads tend to slow down, and ultimately they start going negative, right? We start to shed payroll. We're just not seeing that. So if you take one number to pay attention to, it's non-farm payrolls on a monthly basis. It comes out from the Bureau of Labor Statistics. Again, it's probably only interesting to nerds like me, but it really gives you a tell on how businesses across the country are doing. Yes, there are anecdotes where there are individual companies that are shedding employees, but the bigger picture, the 30,000-foot picture, is that every single month for the last 2.5 years, we've added to payroll, and that is really what's driving economic growth in our country.
Another sort of quick view of a headline, month to month, you're almost certain to hear inflation happened, but that's the way the economy's set up. It's the rate of inflation that's the more important tell, correct?
Correct. And we want to be really careful here because we have been telling our clients and prospects in the conversations that we're having that inflation is improving. And what we mean by that is that, for much of the last 3 years, inflation has been somewhere around 6-7%, depending on your measure. Inflation's under 3%, but that doesn't mean prices are going down. Prices are not going down. Prices are continuing to rise. They're just rising at a much slower clip. So it's a good news, bad news situation, because I know that many people out there are lamenting at the fact that they can't go to the grocery store and pay the same amount for a basket of groceries that they paid in 2020. And the reality is we're not going back to those prices. What we are seeing today is prices are rising at a much slower clip than they were over the last 3 or 4 years. And when you counter that with wage gains, let's call wage gains of 3 to 4%, which are probably going to outstrip inflation over the next 12 to 24 months, consumers are going to start to catch up, right? Over the last 3 or 4 years, inflation might have been 6 or 7% and wage gains were 3%. Consumers fell behind. What we want to see prospectively is wage inflation of 3 or 4% and actual inflation of 2%. And when you compound that over 2 or 3 years going forward, then consumers will catch up. But that's a long story to tell, and it's a hard one to tell as well, because what we want, our clients are telling us they want to go back to the prices for eggs and milk and gasoline that they saw in 2020, and that's simply not happening. The only time that you see something what an economist would call deflation, or prices actually going down, is when you have kind of an economic catastrophe. There's really only been 2 times in our economy in the last 100 years, during the 1930s and then 2009 and 2010, where prices actually declined for a basket of goods and services. Every other kind of stretch that we've had in our country over the last 90 years, prices have gone up, and what you want to see is prices go up at a modest clip, let's say 2% a year. If that happens, we're going to feel a lot better about ourselves, because typically wages outpace the gain of inflation, and over time you start to feel a little bit better about things that you're buying. You feel a little bit, you'll have a little bit more discretionary income relative to your bills.
We have a new administration coming in at the federal level. Are there clear signs of potential strengths, potential challenges that you're watching with the Trump administration taking over for the Biden administration?
100%. This has been top of mind for our clients and prospects over the last several months. You know, as an investor, we try to stay agnostic when it comes to Washington, and simply from what we know today perspective, we think there's a couple things that are clear positives from the rhetoric coming out from the new administration that's set to take place in January. One is that our expectation is that tax rates are not going to go higher. We know that personal federal tax rates under a Republican presidency, House of Representatives, leadership in the House and leadership in the Senate, they're going to keep your personal federal tax rates at worst where they are today. I think there's going to be a push to potentially try to lower personal federal tax rates. We wouldn't necessarily bet on that, but we don't believe they're going to go higher with the Republican sweep in the elections that we saw in November. And corporate tax rates, I think it's a similar idea. Corporate tax rates in the U.S. are around 21%, very competitive globally. These are not going to go higher under this administration. President Trump has said he would like to see the corporate tax rate go from 21 to 15%. Again, we're not ready to bet on that, but they're certainly not going to go higher. As an economist, as a purveyor in financial markets, what you want to do is see fewer frictions coming out of Washington. And without taxes going higher, that's good for the economy. The other true positive is we think there's going to be fewer regulations in some key industries. That's what President Trump kind of campaigned on. Fewer regulations in energy, financial services, some areas of technology, and less antitrust legislation. What we think, you put these less regulations or fewer regulations around the economy, it's going to be easier to see capital flow from sources to uses. And again, these are one of those frictions that are out there. You want to see fewer regulations, fewer frictions, and you want to see capital flow freely throughout your economy. So when you have an idea of a benign tax environment and a little bit more benign regulatory environment, the invisible hand of capitalism tends to do quite well in allocating scarce resources to dire or to important uses, and that's what we would expect going forward. So there's a couple of clear positives on regulation and taxes that we think will be a tailwind for economic growth going forward.
Tom Jalics, it's been fascinating, and we really appreciate the time and perspective.
My pleasure. Thanks for the invite. It's wonderful talking with you.
Our thanks again to all the contributors who joined us for this episode of the Business Equity and Opportunities podcast. We hope you found it enlightening, useful, and inspiring. You'll find more information about the show on our website, BEOshow.com. You can watch Business Equity and Opportunities Sunday mornings at 10 on Wish TV or live stream it through wishtv.com. Each week we provide 7 full segments with topics ranging from how to get started and how to access capital to the day-to-day running of your business and questions about accounting and bookkeeping. We feature business news and trends and always share a success story from one of our contributors. Join us next time for more insights into the world of small business. Be sure to sign up for our Business Equity and Opportunities newsletter to get even more valuable, up-to-date information. And if you have any questions or you'd like to be part of our show, please email us. The address is BEO@wishtv.com. We'd love to hear from you. I'm Scott Sander. Thanks for listening.
Watch the Business Equity and Opportunities Show on Wish TV and access all of our content and share it on demand anytime at BEOshow.com. You can find more podcasts from Wish TV on the All Indiana Podcast Network at allindianapodcastnetwork.com.